Okay, so good afternoon, everybody, and welcome to this week's webinar of FX Street. FX Street, thank you very much for having us. What we're going to talk about today is how to diversify your risk and ultimately how to trade like a fund manager. So talk about some of the distinct differences that in the way that retail traders trade to the way that fund managers trade. And believe it or not, actually, we all, as retail traders, people that aren't trading billions and billions of dollars a day, we all have a distinct advantage over the multi-billion-dollar hedge funds and big banks and all of that with our trading. And we're going to talk about some of those in this webinar today. Before we get started, we obviously have to go through the regular disclaimer, which is to say the content of this webinar is not for investment advice. And it should be used purely for educational purposes only, okay? This kind of goes more for when we're doing live trading and stuff like that, but even so, all of the content of this webinar is for educational purposes. It's there to help you learn to become a better trader, ultimately. And obviously, you're all aware that spread betting or any other financial trading carries a high level of risk, okay, with the possibility of losing considerably more than your initial investment. Okay, so now we've got all of that boring stuff out of the way. I'll quickly introduce myself. My name is Alex Song. I'm the co-founder of a website called Traders Corner, which is a website that I run with my brother. Been trading the FX markets for nearly a decade now. And we've written various articles together. We've written strategy manuals, developed video courses, and coached many traders, thousands of traders, in fact, around the world. We deliver seminars, and if you'd like to follow me, it's at AlexOngUK. Okay? So now let's get into the content of this webinar, why we're all here. And that's ultimately to understand how to trade like a fund manager. And what we're talking about is we're managing a portfolio instead of a trade. Now, as retail traders, we focus way too much energy on individual trades, right? So we're focusing on the next trade or the next trade or the next trade, whereas the bigger fund managers, they actually focus their energy on their entire portfolio. And what that's to say is that the outcome of a single trade is kind of irrelevant because they understand that every trade can be a win or a loss. Ultimately, you don't know every market participant that's in the trade at the same time as you are. So it's impossible to know the outcome of any one particular trade. Therefore, it's absolutely ludicrous to believe that you're going to be right on every single trade. You have an edge, but your edge plays out over time. Okay, now retail traders don't understand this concept and they get so carried away with the outcome of one trade or two trades or three trades when actually they should be looking at managing their entire portfolio. Now, the portfolio may be made up of FX pairs. Okay, it may include some stocks as well, some commodities, whatever it is, it doesn't matter. The important thing to understand is that one of the differences between retail traders and the fund managers, the retail traders are focused on one strategy, one pair, one trade. Okay, and that kind of takes up so much energy of theirs that when they take a loss, it's a lot harder to pick themselves back up. Whereas fund managers, they have an entire portfolio. Okay, and they'll have various FX positions, some commodities positions, some stocks, all of a complete diverse portfolio of instruments, if you like. All right. Now, fund managers diversify their risk by strategy, instruments, and oftentimes fundamental idea or fundamental driver. And we'll come to each of those later on in this webinar. But right now, I just need you guys to understand sort of like some of the key differences between the two, which may give you sort of like an idea of where you're going wrong and how you can improve your trading. So diversifying your portfolio, why is that a good idea? Well, diversifying your portfolio ensures that you're making the most out of every market condition. All right. So on the previous slide, I said that, you could diversify in terms of strategy. So you may have a trend trading strategy and you may have a range trading strategy for them when the market's consolidating and it's going sideways. What this will ensure is that no matter what the market condition, you are always taking profitable trades. Yes, you'll be taking losing trades, but your equity curve will be moving steadily upwards because if you have a solid strategy or solid strategies, then those strategies will obviously take losses, but those strategies should basically protect you from your losses in the bad times and make the most of your winners during the good times. So when one strategy is going badly, obviously you're taking some losses, but you're not taking anywhere near the size of the losses maybe some of your winners you're taking with one of the other strategies that are working at that particular moment in time. Does that make sense? So by diversifying your portfolio and having different, even if you're trading the same market, so we're all here looking at the FX market. So even if you're looking at the FX markets primarily, the fact that you've got different strategies there allows you to diversify your risk. So if one strategy isn't working, the other one is. Okay, sometimes you will get both strategies not doing so well at the same time, and sometimes you'll get both strategies doing wonderfully at the same time. But the important thing here is to smooth out your equity curve. So you get a nice upwards trending sort of movement on your P&L. Does everybody follow me so far? Excellent. So how do you diversify? Well, there's kind of three main areas you can use to diversify. First of all, we just spoke about it, your technical strategies. So who here is a day trader? Anyone? Who here is a swing trader? Yeah. Anybody position trade here? You're a profit trader. Okay, here's another one. Does anybody who likes trading with the trend? A fair few of you. Anybody there like trading against the trend? So selling tops and buying bottoms? Sometimes. Okay. So what that should prove to you, just in this room here, we've got 31 people, okay? And we've had many different answers. So some of you are swing traders, some of you are position traders, some of you are day traders, some of you like trading with the trend, some of you like trading against the trend. What that should prove is that there's many ways to extract profits from these markets. And therefore, if you take a step back, okay, and you don't just focus on one strategy, but instead you allow yourself to look at 2 or 3 different strategies. For example, you've got one for a range-bound market, one for a trending market. Maybe you've got one that's sort of like a swing trading system. You're in the markets for, I don't know, 3 or 4 hours to 3 or 4 days. And maybe you've got a position trading system where you could be in the markets for a couple of weeks to a couple of months. What this ultimately means is that you can have many trades on at the same time. And even if one trade may be losing you some money, you can also have other trades that are making you money. And as I said, if your strategy is solid enough, or your strategies, are solid enough, then the trades that lose you money shouldn't be losing you anywhere near as much money as you would be making with the ones that are obviously profitable for you. Okay? So the first way to diversify is in terms of technical strategies. The second is in terms of instruments. So, obviously you guys are here trading FX, which is fine. And it's a little bit more difficult to diversify just, with the one asset class with just looking at FX, but it is still possible. So, you may not want to be taking trades in the euro dollar, Aussie dollar, pound dollar, all at the same time. Why? Because even though you've got different base currencies there, the dollar part is consistent throughout. So if something happens in the US, okay, then that's going to affect every single trade. So if you're long all of those pairs at the same time, and some sort of I don't know, catastrophe happens in the US, that's going to hit every single one of those positions all at the same times. All okay, relog in and click yes. Okay. So even though it is a little bit more difficult to diversify if you're just trading FX, it still is possible. So maybe you may decide to look at some, some pound type trades, and then you might have 2 or 3 euro trades and maybe one on the Swissy or, but basically you try and chop and change it. You're not trading completely correlated markets. And the other way is from a little bit more of a longer term perspective, but trading different fundamental ideas. Okay, so for example, a little while back, we were trading 2 primary themes, my brother and I. The first theme was that the yen was way too strong for where it was. This is when it was down at sort of 78, and we said, ultimately it can't stay here for that much longer. It has to weaken at some point. So we were kind of building positions into that, and we actually rode that one up to about 95 before we got out of that particular position there. And the other one obviously was to do with with Europe and quantitative easing, and we were trading that accordingly. But they were longer term positions that we were building into over a period of time. So technical strategies, you can, how do you do that? You could have a swing trading strategy, day trading strategy, position trading, trend or range trading. And instruments and fundamentals, we actually already just spoke about that a little bit anyway. And I'm quite conscious I want to get onto the part where I show you quite an effective strategy at the end of this, and something that you can use, pretty much tomorrow to start trading and making money. So I won't dwell too much on the ideas and on the theory. We will work more towards the practical in just a second. But one of the things that I said to you earlier on today is that we have an advantage over the big funds, okay? We are actually in a better position than the huge hedge funds out there, the Paul Tudor Joneses, the Goldman Sachses, all of the big banks. Why? The answer is size, okay? These guys and girls, if they want to get in and out of the market, they need to plan way, way in advance. So they need to be looking at things like, they'll try and get into a position maybe over the course of a day to get their full allotment there, or sometimes even over the course of a few days, they'll be taking a position in a particular currency pair. However, with us, we can get in and out in literally the click of a button. A second, we won't move the markets. Okay, we are too small to move the markets, and that's actually an advantage to us because that allows us to be nimble. Okay, it allows us to be agile in the markets. We can get in and out without moving the markets, which means that ultimately, we're not suffering too much slippage on any of our positions. If you think about it, if you think about one of the big funds wants to take, billions and billions of dollars worth of a position in, I don't know, let's choose one of the more exotics, the Euro-Swedish krone, for example. They're not going to be able to get in there without the market moving. When they try to take their position, the market is going to move considerably. So what does that mean? Let's say, for example, let's hypothetically say that 1.000, okay, is the exchange rate. If not, but we'll use that because it's nice and round. If they wanted to buy and they bought at 1.000, it's perfectly within reason to expect the market, by the time they get into their full position, for the market to be 20, 30, 40, maybe even 50 points higher than where they first wanted to get in. We're complaining about having slippage of 1 or 2 pips, right? That winds us up, but they need to be taking positions where it may take them 50 pips or sometimes even more to get in there into their entire position. Do you guys follow that? So can you see why we do have an advantage over the bigger boys? Yes, they have all of the analysts around them and all of that. But actually, fundamentally, when it comes to the actual trading parts of it, we are better than they are. We can be in and out quicker than they can be. And Lord knows we can leverage our money a little bit better as well. Not that I'd recommend it. It's a double-edged sword, but you have some brokers out there offering something ridiculous like 500 to 1. I don't recommend that, by the way, but just an example. Okay. So I want to teach you a simple strategy. All right. It's a simple strategy that's based mainly off of price action. It's easy to follow. It has a decent strike rate. So you're talking sort of between 55 to 65% strike rate. It's a strategy that keeps you on the right side of the market, and you only use 3 indicators. Okay? This was actually one of my favorite strategies for a long time. It's still profitable. The reason I don't trade it as much anymore is actually we fine-tuned things a little bit with the aid of range bars and a few other things. But nevertheless, this is something that, we used for a very long time, and it was very good to us. All right. So 3 exponential moving averages. Yes, it's only good in trending markets, but fortunately, this will keep you out of most of the range-bound markets as well. The 3 exponential moving averages are the 25, the 55, and the 100 moving average. All right. 25, 55, and 100 moving average. Once the moving averages have aligned, and what I mean by that is if we're looking for a long opportunity, the 25 should be above the 55, and the 55 should be above the 100. If we're looking for a short opportunity, the 25 should be below the 55, and the 55 should be below the 100. Once all of the moving averages are aligned, you're looking for the market to pull back, for price to pull back into the value area. Now, what do I mean by value area? I'll show you that when we get to the live charts in just a second. So we're waiting for the market to pull back to our value area, and then we're going to enter according to our favorite entry technique. Now that means, you may be studying candlestick patterns. Wonderful. Use your bullish, bearish, engulfing patterns, your shooting stars, your hammers, all of that. So whatever entry technique you prefer, maybe it's the break of a counter trend line. You place your stop behind the swing. Okay. And your take profits needs to be at least 1 to 1. Does everybody follow that? Oui? Ça va? Okay. So what we'll do now is let me get rid of this slideshow a minute and let me show you on the charts. So these are the charts in front of us. Right. What we'll pick is let's pick a daily chart. You can see these are the moving averages here. So this is the 25. This is the 55. And this is the 100 moving average. Now we're looking to take trades once price pulls back to a value area. What do I mean by that? Well, we don't want to be getting into the markets at the tops. I know that people say buy high, sell high, or sell low, buy back lower is the way to make money. But we're looking for a bargain. Yes, there's a little bit too much disturbance here, but as you scroll back, you will see conditions that are favorable for your strategy, and that's one of the secrets to trading. Every market condition doesn't suit the one strategy. You need to be picky about your trades. Only wait until the absolute perfect conditions show up for your strategy. So back to what we're saying. So let's look at this one here, okay? This is a short opportunity. We've got the 25 below the 55 and the 55 below the 100. Once we get this alignment of the moving averages there, we're waiting for the price to pull back to a value area. Now we consider the value area somewhere in between the 25 and the 100. Generally, it tends to be somewhere nearer the 55 moving average, but just within this area here, we consider this the value zone. We consider that this is where the markets have absorbed the previous move. Okay, the previous move was down. They've absorbed the previous move. Now, all of the sellers that were involved in this prior down move over here are going to be looking to make money again. And they've got short-term memory, okay? So they're going to be looking to get short the market again, because getting short the market last time is what paid them. So they're going to have another punt at this. But they don't want to do it down here. They want to book some profits, and this is what all of this is, and wait for the market to digest this previous move there. Once the market's digested it, then they will look to get short again. How do you get short? Well, as I just said to you, ultimately you use your favorite entry technique. That could be a break of a counter trend line. So let's put a counter trend line in here. Oops. So we could wait for that counter trend line to be broken. It could be some sort of a topping formation. So you have sort of like a doji up here, spinning top type candle. Then you've got a bearish, very, very big bearish candle over here. All right, so you may decide to get in after that candlestick formation. Stop above the high, look for one-to-one, which would be down here somewhere. You can go for more than one-to-one, but ultimately it's your favorite entry technique. What I'm showing you here is a way to stay on the right side of the market and where to look for your opportunities to get back into a trade. Is everybody following this so far? Will you have losses? Of course. There's a loss right here. And this is a fantastic trade. This is the sort, in fact, I think we were actually in this trade here looking at this. This is the sort of trade you want to be in. Massive move to the downside. Nice pullback to a value area. And then you get short around here. Market would have stopped you out. That's life. That's what trading is, boys and girls. If you're looking for an opportunity where you don't take any losses, unfortunately, the markets are not for you. However, if you can remain disciplined, so that one would have stopped you out. What about over here? Nice down move, a little bit of a pullback to value. When it pulls back to your value area, you look to get short here. The market pays you. All right, messes about a little bit, but ultimately it pays you. What about over here? When the trends are strong, you can pretty much buy anywhere around this area and you will make money. Obviously, it's a bit more efficient if you have an entry technique, candlestick formations, counter trend line breaks, something like that. But ultimately, looking at this here, the moving averages, Rahul, by the way, is what should keep you out of the whipsaws. You can't be kept out of every single whipsaw. You will have losses on this system. But let's just look at this here. Forget your entry technique. Let's just look at what happens when moving averages align and price pulls back to your value area. So you buy somewhere here. Does the market come back to this low again? No. What about up here? If you bought here, does it come back there? No. What about here? No. Here? No. So as you can see, when the market pulls back to your value area, as long as there's a strong trend there, yes, you may be given some pain. No one wants to sit through all of this, but ultimately it goes to hit your profit target. Make sense? My entry technique, we use range bars and Henkaishi bars to enter with this sort of a system. Take a look again. Market falls off a cliff, pulls back to value. The first time it does, what happens? It continues its downwards movement. Over here, market pulls back to your value area. What happens? You get stopped out. Does it matter? No, not really. Because there are many more opportunities for you to make money than there are for you to get stopped out. And some of it is about learning to read a chart. Absolutely. You can't get away from that. Okay. How do you handle economic data releases? It depends what chart you're trading, FX Boyki. So if you're trading something like a 4-hour or a daily chart, unless we're talking non-farms, I don't really care. if you're trading a 5 minute, 15 minute chart, then perhaps you want to stay out, half an hour before and half an hour afterwards. How do you avoid a ranging market? Well, you wait for the moving averages to align. You can't avoid every single ranging market. That's impossible to do, unfortunately. Is this good for binary trades? Well, interestingly enough, that's something that we've been doing quite a lot over this past year. With the volatility in the markets, they've decreased quite a lot. So you don't get the sorts of moves that you did, 2-3 years ago. We have been taking quite a few binary trades using similar systems similar to this. Not this exact one. Okay, I'm not going to lie to you and say we trade this exact system for binaries, but it's very similar and it's very profitable. How long have you been trading binaries for? Okay, the thing you need to remember about binary options is that here I'm showing you that the price doesn't pull back to a particular value area, so you wouldn't be stopped out. Binary options, you don't really care about being stopped out because you can't. Binary options is much more time dependent, okay? So what I mean by that is if you look at these things here, these trades here, even though ultimately it never pulls back to your stop area, it takes a long time to take you into profit. So depending where you got in on this trade here, the binary option may have expired out of the money. And that's something you need to think about. Where do I see the pair right now? The euro dollar. At the moment, there's nothing. There's no real defined move in either direction, so I would look for something else. On one of our other strategies, we got a sell up here, which we've just come out of. So we've got a sell trade up there, and we took it down to the support area down there. But as far as any trade on this system, there's nothing. So does everybody have a good grip on that system there? Does everybody have a handle on it? Do you understand it? Yeah. Are there any questions? Which is the value area? The value area is anywhere between the 20. This is what we consider value. Yeah, so this is ultimately an area where we believe that the bigger boys, the people that have been making money in the big moves, so looking at this trade here, for example, they made all of this money there. They're not going to be looking to sell any more down here. They want to see the market pull back a little bit. They want to get bargain prices. They don't want to sell at the lows. They want to wait for a bit of a rise in price and then sell from there. And that's what we consider value. I trade divergences. Where would you rank the strategy in a count of 1 to 10? This strategy here, I'd give it a 7. Everything is sunny clear. The range chart, I'll show that on a different webinar, FX Trad. I know you've seen a couple of my webinars before, so you've probably seen the range charts before. On 4 hours I stay in, yes. Is it advisable to get Ninja Trader and look at range bar charts? I like range bar charts. So yes, I'd always recommend that. This strategy is, you can use this on any on any time frame you want. So 5 minute, 15 minute, hour, 4 hour, daily, whatever it is you want, it works just as well. I couldn't comment on the MACD strategy, to be honest with you. It is a very good way to trade, isn't it, Vinay? You would like to shift to Forex. When will we have begin? What do you mean by that? When do we teach beginners? Do you mean? Oh, okay, we teach beginners all the time. If you drop us an email, we can talk about how we can help you out. I'll type my email into the box here so you can see it. AS, what you trade now? Sorry, Boyke, I'm struggling with that. What do you mean? Yes, we have had there's actually some recordings on FX Street for some of our range bar webinars. And we're going to be releasing a completely free FX course with FX Street. So in the coming weeks, there are about 20 or 30 different video lessons. Some of those include talks on range bars as well. And we're going to be doing that in conjunction with FX Street. So watch this space here. And I think that will be a really great place for you to start. And it's free. So we all like free now, don't we? Thank you, FX Street. So are there any other questions? Do you guys understand what we're talking about here? I know that these are short sessions, but the information I'm giving you is very, very valuable information. So I've given you the strategy here, but also just as important is what we talked about before. Okay, so not focusing on the one trade, having a bit of a diversified portfolio. That if you can start to implement some of that, you'll see that your trading improves, not just because your strategies are making you money, but your psychology is better as well. You're not just focusing on the one trade. You're focusing on your portfolio. So the outcome of one trade doesn't make a difference to you. And you'll find as a result of that, you're more positive about your trades and you will do better with your trade. Exactly, Nicola. Do I have any New York time zone trading room? No, we don't. Not currently, but it's something that we can look into in the future if that would be of interest for you, Sol. Yeah, I mean, generally somewhere around the 55, but in that sort of area there, yes. But this strategy is just as good. Well, not quite, but it's nearly there. So this is what we used for a long time. So it's good enough to make you money. It depends what you're like as a trader. It depends what suits you. I prefer shorter time frames, to be honest with you, and I've always had better results on shorter time frames. But I know people that prefer the longer term time frames. So yes, trading on FX. Drop us an email, Haji Sadu, and we'll see what we can do to help you. As I said, look out in the next couple of weeks because we're going to be releasing a video course with FX Street, which is completely free of charge. And it will really help you with understanding the fundamentals and the foundations of what you need to do to be a profitable trader. FX Boyke, I trade a 3-range chart, 3-pip range. That's quite quick. What do I think about the euro dollar now? As I said earlier, the euro dollar now for me is just, well, there's nothing. It's It's in no man's land. I couldn't pick a trade here if my life depended on it. Are there any other questions? Short 13750. Who, us? Or you want to be short from 13750? Which pair do you suggest to be a good trendy for the 1 hour? To be honest with you, it's not that. That's in fact that's something that I'll talk about before we wrap up here. I used to be the same. I used to say which pair is the best pair to trade, or which market is the best one to trade. To be honest with you, every market goes through good stages, good cycles, and bad cycles. That's why we talked about diversifying the portfolio, because you can't just say, oh, just trade the euro dollar, just trade the pound dollar, because they all go through cycles. So some of them are great to trade at points, and other times they're absolutely horrific. So by diversifying your portfolio, by looking at different currency pairs, maybe even commodities and some stocks, and it ensures that even though you may be having a hard time with one or two, the others are paying you. And that's the whole point of this webinar here. Is that you've diversified your portfolio enough so that you don't have to focus on just looking for the best trending 1 hour time frame pair. You can look at many, and therefore you'll make sure that you're always in a market that is paying you. Because at the end of the day, that's the point, right? That's what we're here to do. We're here to make money. Are there any other questions? Salute. It is a very good strategy. No, the EU chart isn't a range chart. This is a normal time-based chart. This is a daily chart. Okay, well, if there are no other questions, I will thank you all for joining us this week. It's been a pleasure having you. Thank you very much to FX Street as well. I hope you've all had fun. You've all found some value here. Please make sure that you really take it in what we've talked about here, because it is valuable stuff. This isn't just one of those webinars where we're just, talking for the sake of it. What we've spoken about here is very, very important. It's very, very valuable, and it will help you in the long run. I promise you of that. Okay? So until the next webinar, thank you very much for joining. Have a very good day, and we will speak to you all very, very soon. Okay, thank you, FX Street, and all have a very good day now. Take care.